Again, everybody, Dimitri James here, Virtual Financial. Today, I want to talk to you about mortgage protection, or more specifically, mortgage protection insurance. So, what I'm going to do is I'm going to show you a couple of examples of what that looks like. Now, if you've bought a home, or you're planning on buying a home, you've either seen or you will see a form like this that comes into your mail to actually fill out. It comes in several different varieties. But nonetheless, it's all the same. And it doesn't matter who you are. Again, if you've bought a home in the last 10 years, or if you're going to be buying a home sometime soon, you're going to see something like this arrive in your mail. I recently purchased another home here in the last 5 years myself, and even I got bombarded with a bunch of these. I probably got about 20 plus, if not close to 40 or 50 of those in the mail. And it happened for a number of weeks, a number of months. So today what I want to do is I want to actually have that conversation with you before you have to actually have someone come over to your house, sit down at your table, and have that conversation with you. Again, with my services here at Virtual Financial, my company, we can have that conversation without ever having to meet physically in person. As a matter of fact, we prefer not to. We're in all 50 states, parts of Canada and Puerto Rico, because we do everything virtually, meaning that what we're going to do is actually have a computer screen share where you can actually see us go through the entire process as if we were sitting face to face. Now, more times than not, you're not able to see my face. I'm not able to see my face, but if you're more comfortable with at least seeing someone's face so that you have, for a comfort level sake, then we can actually do where we can see each other's face as well. But in most cases, you're more than welcome to sit there in your pajamas, be comfy, and let's actually just have an actual intelligent conversation about your finances. In this case, again, we're going to be talking about mortgage protection. You with me? All right, let's get to it. So, with mortgage protection, or more specifically, mortgage protection insurance. Mortgage protection insurance is simply life insurance with a purpose. The purpose in this case is going to be to protect the mortgage. Now, starting there, let me first explain that a lot of people, when they get life insurance, they kind of come up with an arbitrary number. 100,000 sounds good. $1 million sounds good. $500,000 sounds good. My thought process, especially in all of my conversations that I've had with people, is what is it that you're trying to accomplish? Let's be strategic about your life insurance. Let's be strategic about all of your investments, all of your financial vehicles. Does that make sense? So in this instance, mortgage protection is simply life insurance with the purpose of protecting the mortgage. Again, your life insurance is traditionally more for those that you love, your wife, your children, family members, friends, people that you still want to continue to protect and love in the event that you were to pass on and were unable to physically be there for them. It's a way of helping extend that love and care for them. Does that make sense? All right. Life insurance with a purpose, or for this instance, mortgage protection. So it comes in a couple of different ways. When you sit down and have that conversation, we're just kind of going to have it right now. The most common is going to be term life insurance. Again, what that life insurance policy is going to be, it's going to be in increments of 10 years, 15 years, 20 years, 25, or 30 years. Again, if you're not very familiar with term life insurance, all term means is that it's going to be there for a specific period of time. That contract is going to be good for a certain amount of years, 10, 15, 20, 25, 30 years. Got it? Good. If you want to check out one of my other videos, I kind of go over that in a little bit more depth, all right? But that's the basic. Another type of mortgage protection insurance that's common out there is going to be a term life insurance policy with a return of premium, or most commonly known as money back or cash back. So this is in essence where after you've paid all that money, you get the money back that you've paid into it. Most people that I talk to about life insurance that are not very well versed in it, one of their biggest complaints is, well, what happens if I pay that that life insurance premium monthly payment for 30 years and I don't die? Well, my response is, great, you're still alive. That's the best outcome you could actually have. But in all essence, in most cases, it goes away. You paid for it, it's insurance. Think about it like this. If you have car insurance and you don't get into a wreck, that's a good thing. However, you don't get your money back for not having gotten into a wreck. Does that make sense? Now, again, that's a good thing. The best case scenario is you want to live, you want to be around your family, you want to enjoy your family, enjoy your life. But it is insurance for all intents and purposes. If you don't die, most times the money is going to go away, or you don't get that money back. But there is a type of term or an option for a term life insurance policy where you do get the money back. Obviously, you pay more for that, and I'll go over those illustrations here in a minute. But that is an option as well, because that's one of the concerns that a lot of people have, especially when they've saved up and they've just bought a house and they're thinking more critically about their finances. You with me? Good. All right. Another tool that we use, or type of life insurance that we use for mortgage protection, is whole life insurance, or some people call it final expense. Usually when people have a whole life insurance policy or final expense policy, what they're typically trying to do is make sure that funeral expenses are paid for. Does that make sense? Nobody wants to leave anyone having to figure out, having to raise money, do a car wash, heaven forbid a GoFundMe, especially when like 90% of those never get adequately funded. No one wants to have to do that. But what we've been able to do, at least in my conversations, I've been able to help a lot of people who either cannot afford or cannot qualify for the requirements or the cost when it comes to term life policies. I've been able to help them get a little bit more creative and put together a whole life policy or a final expense policy with a purpose of still protecting that mortgage, all right? So I'm going to go through some of those, and then I'm going to talk about another option that's newer called term life with living benefits. But first, let's go through those. I wrote up a couple of different scenarios here to make everything real easy. So the first thing I'm going to go over is term life insurance, and we're going to go for 30 years, all right? So let's say, actually I don't like that marker, let's get a different one. Let's say we're actually going to get rid of that 500,000. Let's be a little more affordable here. And more specifically, these are just the numbers that I kind of already worked with to be able to illustrate everything for you. All right, so let's say you have a $250,000 mortgage. The mortgage is going to be for 30 years, and we're actually changing the age to, my apologies on that, we're actually going to do the quote at age 40. So, $250,000 mortgage, 30 years, age 40. I'll tell you, I'm all over the place. I'm dropping markers and everything else. So, in this case, 40-year-old female. And non-smoker. And I always put these qualifications on there because I'm always going to give you guys actual quotes as of today. All right? Meaning if I was talking to you today, this is how that quote would look if you were in these parameters. So 30 years. Actually, you already know that. 30-year term. Trying to save a little space here. Would run a 40-year-old female that didn't smoke for $250,000. $98.12. Now, for the cashback option, or return of premium, that same policy would run $168.64. And at the end, she would get back 60 grand, 60,710 dollars and 40 cents to be exact. So again, if it was just straight for 30 years, $250,000, in order to protect that $250,000 mortgage that she has, in the event that she was to pass, if she outlived, that would run $98.12 a month. Now, if she wanted to do the cashback option, meaning return a premium where you get your money back if you outlive that, then that monthly premium is going to jump from $98.12 to $168.64. And if she should outlive that, she's going to get a lump sum check of $60,710.40 back. Are we clear on that and how that works? Again, it's going to be more money in order to get that money back option on there, but it is an option. Now, if she dies anytime within that 30-year time frame, it's still going to pay out the same amount, $250,000. Now, I want to show you another illustration, because let's say we're having an affordability issue. You know, you just bought a house, things are tight, you got all these new expenses that you've never had to deal with before, and so money's an issue. Let's go ahead and again, be strategic about it, because it doesn't make sense to try and pay for life insurance that you can't afford, then it ends up going away. Or you're paying for a life insurance policy to protect the mortgage on the house, and then you end up losing the house because you can't balance both payments. You understand what I'm saying? So let's say a strategic way that we would do that is we would, instead of going $250,000 as far as a life insurance policy, we would go $125,000 plus, okay, plus another $125,000 of accidental coverage. So what that means is that instead of doing the $250,000 life insurance policy for 30 years, we would do $125,000, and then we would add an accidental portion of $125,000, meaning that if you should die in the form of an accident, it's going to pay out the total of $250,000. Now, if you die of natural causes, health-related issues, it's only going to pay out $125,000. However, if you're able to qualify for the policy, more than likely you're in decent health, and chances are, if you die anytime soon, while you still have the bulk of this $250,000 mortgage, it's probably going to be accident related. Does that make sense? It's not like you're going to develop something, more than likely you're not going to develop something, you know, within a month's time of actually qualifying for this policy after getting that mortgage, and then you know, you're gone in the next couple months. It usually doesn't happen that way. Not saying it can't, but it usually doesn't. So what that means is that, okay, that policy, instead of running you the $98.12 that we showed earlier, would now only run you probably have this over here, $63.97. A big, over $30 difference from the $98.12. Now, let's say you want to do that return of premium. Well, what about the cash back option? Well, let's do it that way as well. Same $125,000 plus $125,000 with return of premium or the money back option. Instead of that being $168, that would run you $108.53, and the money you would get back would be $39,070.80. Again, all we're doing is trying to be strategic. Now with the 125 and 125, we still have the $250,000 covered, particularly if an accident happens. Now let's say an accident doesn't happen and you get down to year 28, 29 or something like that, or halfway through this mortgage, 20 years into it, and you pass for health-related reasons, and you only had $125,000 in there. or for your life insurance policy. Well, as years go by, this amount is going to drop. So at some point, you should be around 100,000, 50,000. That's all that you owe on the house. Now, here's the other thing that people don't realize. Your mortgage, or excuse me, the equity in your house, is like having a bucket full of money. So, see if I can draw a money bag. I'm not an artist, as you can tell. But the equity in your house is like a bag of money. Let's remember, that's your money, or that's the money that you can leave as a legacy, even if you don't have an inheritance or something happens where, you didn't have a life insurance policy. If your loved ones are able to actually recoup the equity that you've accumulated in your mortgage over time, then that's like leaving an inheritance in itself. So again, life insurance with a purpose. In this case, it's protecting the mortgage, or it's protecting that bag of money, which is called equity that you have, which is what in your house, which is why you even got a mortgage to begin with. Are you kind of seeing how all this is lining up? Good. I know I'm kind of going a little fast, but I'm hoping it's all making sense to you. Let's continue. Let's move on. Let's continue. So now let's go with another scenario. Let's say we have an issue where it comes to we have an age difference in age. Let's say age 60. Years old, female, non-smoker. Let's say that prices were a little too much at age 60, or we had some health-related issues that wouldn't allow us to get the actual term policy, but we can qualify for a whole life policy. So this is where we're going to use the whole life or final expense type policies in order to be strategic and still help protect the mortgage here, okay? So in this scenario, let's say we go with a $40,000 policy, whole life, meaning that it's never going to go away. It's just going to be there until the day that you pass. It's designed to go all the way up to age 121. No one's ever made it yet, at least not since biblical times. And that's going to run $121.86. All right. Now let's say we want to try and double that number because we want to get as close to that $250,000 mortgage as possible. So we add accidental. That's going to run $133.43. As you can tell, accidental coverage is pretty inexpensive. This is why when you see those commercials on TV, it's like $12 a month and you got 50,000 or whatever the case may be. More than likely it's accidental. So keep that in mind as you're seeing these advertisements on TV. But in that sense, I almost always recommend, again, there's always an affordability issue, that if you can add that accidental, that you just add that extra protection there for a couple, basically pennies on the dollar when it comes to the policy amount or cost. So what this has done, in essence, is it's taken us from $40,000 to $80,000 worth of coverage. Again, we're going to implement the same strategy, the same scenario as we did when we did the lower cost amount there with the term life insurance. So let's say if something were to happen, oftentimes if it's a surviving spouse, or beneficiary, kids or whatever the case may be, you're still trying to protect that mortgage, that $250,000 mortgage. If something happens sooner than later, there's $80,000 there. If something, well, it's going to be there for life. So if something happens from a medical standpoint, health related, then obviously you only got the $40,000. But what we're doing again is trying to protect that $250K. So let's say something happens sooner than later, and it's accident related. Now you got 80 grand in order to help protect that mortgage. Oftentimes, especially in today's culture, people are not keeping homes from generation to generation. Now that may be your legacy that you want to leave. That may be something that you guys have always done in your family, and it's something that you want to do as well. But let me remind you that you got that bag of money. Remember, I can't draw, but you got that bag of money. That's called equity in your home. So while you may have bought the house for $250,000, what if it doubled in value and now it's worth $500,000? And say you got 2 kids, and say you have a spouse. You want to protect that. A life insurance policy is going to make sure that that money, whatever's in the policy, whether it's that 40K or that 80K, gets to your family member right away, so that now they can continue. Let's say if it's a spouse and you were the breadwinner, now they continue making those monthly payments until and then downsize from the house. But take that equity with them. Go buy a $100,000 house, $200,000 house. Keep $300,000 to continue to supplement the income that was lost. Or let's say you have children that you want to leave the house to, but they already have their own homes. They already have their own families. They're in another state. Now, what you've done is you've left them the ability to continue making payments on that house that you bought for $250,000 and recoup, sell that house, try and get as close to the asking price as you want, and now you've left an inheritance for your children, for your grandchildren, whatever the case may be. Am I making sense? Again, we want to be strategic with our life insurance because we want to make sure that our life insurance, all of our financial vehicles, we have them in place with a purpose. All right? So, again, same thing. If affordability is an issue, even with the whole life, because remember the whole life 40,000 plus 40,000 accidental was 133. That's a month. All the numbers I'm putting up are monthly, by the way. Let's say we do a $20,000 policy. That's going to run $68.32. All right, we've pretty much cut that in half. Now again, the strategy doesn't change. In each and every scenario, what we're doing is we're trying to protect that mortgage. And in each and every case, every scenario, what we're trying to do specifically, strategically with our life insurance policy is protect that bag of money we like to say is in your basement, called equity. Again, unless you're just trying to pass down a home that someone else wants to stay in or needs to stay in, and if they do, that's great, because all that means is that, okay, if they continue paying that off, or they need to keep half the money for paying off the house and half the money to keep on, supplementing the income that they lost when you passed on, then great. That equity will continue to grow anyway. But again, what we're trying to do is protect the equity in the house. And here's why. When someone passes, particularly when it comes to mortgage protection insurance, the banks or the lenders or wherever that, someone's coming for the equity in that house, which is why those foreclosure notices start coming very quickly. Again, they want their money. And they don't want your house. They're not going to move into your house. What they're going to do is they're going to take your house and sell it so they can recoup the equity in the house. The reason for mortgage protection insurance or life insurance with the purpose, the express purpose of protecting the mortgage, is to protect that equity in the house. This is a way to leave a legacy, to leave an inheritance, in many cases, for the general population that otherwise wouldn't have any means to leave an inheritance or leave a legacy. Does that make sense? Good. I thought it would. Next, I want to talk about the last type of life insurance policy. It's a newer type of life insurance policy. And if you've gotten life insurance in the last 5, 10, 15 years, you need to get a quote and compare apples to apples with term life insurance with living benefits. It's fairly new on the market, but what it does is it actually allows you to access up to 90% of that policy tax-free while you're still living. Remember what I said, one of the most prominent questions that I ever get when with people that have life insurance, or when I'm talking to people about life insurance, is, well, what if I don't die? Well, again, that's great. We'd rather have you around than have your money. You're worth far more than money. But in the event that you were to incur a terminal illness, a chronic illness, or a critical illness, then again, with that same life insurance policy, you're able to access what they call living benefits, which gives you up to 90% of that policy money. And if that was $1 million, that would be $900,000 while you're still living. Again, you don't have to pay that money back. It comes straight out of your policy. You're basically borrowing it from your policy, and it allows you to have money to either do last-minute things with your family, or get the treatment or the care that you need. If you have an income disruption from that illness, that chronic illness, that critical illness, terminal illness, if you have a job loss because you can no longer physically perform the duties that you were able to do before, or if you have medical treatment costs that you can't otherwise afford, it allows you to access that money. Again, tax-free, folks, and this is built into the policy. It's not like it's going to be an extra disability policy, an extra cancer policy. If you have all of those policies, please, you need to check into this. Contact me, because these are built into the actual policy. And most times, if you've had just gotten another policy within the last 5, 10, 15 years, it's going to be very comparable. In some cases, it's even going to be less than what you're already paying. So this is something that I want to make sure that you're aware of. Now, why is this such a big deal? Here in America, every 30 seconds, a new diagnosis of cancer is happening. Every 36 seconds, a new heart attack is diagnosed. Every 40 seconds, a new diagnosis of stroke is occurring here in America. If you didn't know, the average cost of a heart attack is $1 million. Also, if you didn't know, 60% of all bankruptcies are now medically related here in America. 80% of those folks had health insurance. 80% of those people that went bankrupt had health insurance. Another thing that you want to know, or that you need to be aware of, is that treatment isn't, when it comes to chronic illnesses or critical illness, it's not cheap. I'm sure that if you have anyone that you've known, or if you've been someone who's unfortunately suffered from one of these types of situations, you know the cost of treatment is very expensive. As a matter of fact, studies show that one out of every 4 cancer patients have either delayed treatment or refused treatment that they needed due to the cost factor. If you have not had any of these happen yet, I implore you to look into this and get this checked out. I promise you, anyone that you know that has had or currently does have something like this wishes that they had a policy that would have allowed them to access up to 90% of that policy, so that they can actually continue to address these concerns. What this does, this type of policy, what it does is it actually answers the question, what if you live after suffering a diagnosis of a cancer or heart attack or stroke? Again, life is you can't put a price on life. we want you here more than we want the money. I don't care who it is, your loved ones, whatever the relationship may be. You're worth more alive to all of us than you are if you were to pass on. Nobody wants your money. We want you to actually survive. But if you do survive, we also want you to be able to still live, have a quality of life. And one way to help do that is by being able to access, again, up to 90% of that life insurance policy. Now let's go over some of those numbers, okay? Because I remember I told you that it's kind of comparable. So let's say a 30-year policy. This is going to be on a 40-year-old. Let's use blue. Same, I'm going to go back over the 40-year-old. 40-year-old female, non-smoker, 30-year policy, $250,000 again. Same numbers. Remember, this is the term. It was 98.12, 250,000. Now, here's another color. The term with the return of premium, remember the one that has the money back? That one ran $168.64. This is, again, these are apples to apples. If I was quoting these today for this 40-year-old female at age 30 that did not smoke, standard. This is not special pricing or anything of that nature. And this is going to be term with living benefits. Same 250,000, same 40-year-old female, same 30 years. Incredible, isn't it? Absolutely incredible. Who wouldn't do this? Why wouldn't you do this? Let's break down, remember when we were talking about, okay, what if costs were a factor? And so instead of doing the 250, we had to go 125K or 1,000 plus 125,000 accidental. That number drops to $47.09 a month. Again, this is big stuff, folks. There's never been anything out there on the market like it. And if you want, ask someone that you know about that's had a chronic illness or a critical illness, that's suffered a heart attack, a stroke. Ask them about their experience, and ask them, would they have looked into this if they were able, in retrospect. I promise you, every last one of them would tell you, you need to do this. You need to do this. Now, again, everything I do is a crusade. The reason why I spend time making these videos and giving you all this information for free is because I want you all to have a better chance at getting the financial tools that you need to make the decisions that you would make if you only had the information available to you. Now, if you want to talk to me directly, just go to my appointment calendar, go.onehub.com/Dimitri James. Again, that's go.onehub.com/Dimitri James. Now, if you want to join us on our crusade because you think, like me, that everyone needs to have this information, we'd love to compensate you for it. Again, the average policy that we do is about $75 a month. And that's because we're trying to keep in mind everyone's financial situation. And we want to make sure that we protect not only their budget for insurance purposes in the future, but we understand current household budgets as well. But on average, for someone that just refers us to someone that we can actually help, meaning that, okay, if you're good at social media and you have an audience and followers, whether it's Facebook, Snapchat, Instagram, you name it. If you know people and you know someone that needs to hear what we have to say and we can help them, on average, that compensation to you, the person that's just helping us get in front of people, is $585. Again, this is direct deposit. This is not a handshake deal. It's a contract that we'd have to go through. $585, and that usually shows up in about a week or so from the time that we actually help that person. Now, the kicker on that is this is a great way to supplement income or to actually go into business for yourself. That income, that same $585, typically continues to show up for the next up to 10 years, which means that you helping us just talk to one person that needs to have this conversation, if we're able to help them. Again, we want to do the right thing for them. That can be a $5,850 reward to you, our way of saying thank you, just for doing the right thing, just for helping us have a conversation that someone needs to have with a person, and we're able to help them, and it's the right thing for them. If you want more information on our Crusade and our products, go to my website, DimitriJames.com, for more information, especially about, it's called the Inviter role, the one I'm just talking to you about. It's DimitriJames.agency for the roles and positions. If you're an entrepreneur or self-employed or work at home or have dreams of doing any of those three, go to my website, DimitriJames.biz, get a little bit more information. If you already have another profession, a lot of people we work with are recruiters, marketers, real estate, insurance people, as professionals as well, or if you're in sales or marketing. If you love what you do, you don't have to quit your job. You know what I mean? But we'd love to make sure that you have extra money for helping us just get in front of the right people to have the right conversations, so that now you take the stress factor or the money factor out of your job. Now you can just do what you love. I don't know if you want to be a dolphin trainer like my daughter, but what if you had the money that came in just for helping people on the side? We do all the work. We're going to have those conversations, but you already have an audience, you already have followers, you already have people that you know and love and care about, and you're just helping us help them. So again, go to my appointment calendar. I'd love to talk to you. go.onesub.com/DimitriJames. I hope that you've gotten a lot out of this conversation. Check out some of the other videos if this one didn't apply to you specifically. I'm going to continue to try and upload one or two of these every week as long as I can. Anything I can think of to try and equip you with the tools that you need to make the decisions that you would if you only had the information. Anyway, Dimitri James, Virtual Financial, signing off. God bless.